Welcome to today's explainer. Look, we're going to do something a bit different today. We're skipping the surface level storytelling and that generic financial fluff you usually hear. Instead, we're zeroing in purely on the precise mechanical reality of home workspace tax deductions. We've got our hands on an incredibly detailed anonymous expert report, and we're going to use it to dissect the exact mechanisms, the cause and effect relationships, and really the non-obvious actionable insights that govern how your everyday personal living expenses can be legally, and I mean completely legally, converted into business tax write-offs. If you want to understand this topic at an absolute expert level, purely driven by the data, you are in exactly the right place. Okay, let's dive right into this. Here is our cognitive map for today. We'll kick things off with the home office mechanism, then look at the strict qualification prerequisites, and outline the eligible expense categories. After that, we'll compare the two calculation models, do a deep strategic method comparison, and finally, evaluate the compliance and audit risks. All right, section 1, the home office mechanism. So let's establish our foundational concept right out of the gate. At its core, we're looking at a pretty unique financial opportunity here. It's the legal conversion of standard everyday living costs into deductible business expenses. To really grasp this at an expert level, you have to look at the cause and effect relationship. Basically, operating a business from your primary residence triggers this specific mechanism in the tax regulations. It effectively takes your personal overhead, the money you were going to spend anyway just to keep a roof over your head, and reclassifies it as business overhead. Actually, scratch that. It's more like a profound shift in asset categorization. Think about it. You aren't generating new expenses out of thin air. You're legally shifting existing liabilities into a highly tax-advantaged category. But, and this is a big but, this mechanism absolutely does not activate automatically. It requires some incredibly precise conditions to be met. Which brings us to section 2, strict qualification prerequisites. Now we're getting into the high-tension reality of this deduction. You can't just claim you work from home, point to your kitchen table, and expect the tax authorities to rubber stamp it. No way. You must pass through what the experts call a rigid exclusivity gate. So the absolutely crucial point is this. It is a zero-tolerance policy. The expert report makes it abundantly clear that the designated space must be used exclusively for business. If you have a desk set up in your guest bedroom, and your friend crashes in that room for even one single weekend out of the entire year, boom, that space is legally disqualified. Commingling personal and business activities instantly destroys the deduction mechanism. It has to be a dedicated, specific area where literally nothing but business occurs. Now, you might be wondering about a critical edge case. What if you actually meet that exclusive use test at home? You've got the dedicated room, but your core business activities actually happen somewhere else entirely. This really challenges our basic assumptions about where the principal place of business truly exists in the eyes of tax authorities. Let's walk through a very specific hypothetical scenario detailed in the analysis. Imagine you own a retail storefront, or maybe a restaurant, and you have an office right there on site. However, you occasionally do some bookkeeping from a dedicated, exclusively used spare bedroom at home. Well, under most circumstances, you would not qualify for the home office deduction. Why? Because the non-obvious detail here is that tax authorities evaluate where the core revenue-generating activities actually happen. If the primary engine of your business, the place making the money, is located elsewhere, your home office fails that principal place of business prerequisite. And that's true regardless of how strictly you enforce the exclusivity in that spare bedroom. Let's move on to section 3, eligible expense categories. Okay, so let's say you successfully navigate those strict prerequisite gates. You've got exclusive use, and it's your principal place of business. Now we transition from rigid rules to actual tangible financial leverage. Take a look at these mundane personal expenses mapped out here. We're talking rent, mortgage interest, homeowners or renters insurance, HOA fees, utilities, property taxes, repairs, and maintenance, the whole shebang. Once those prerequisites are met, a percentage of every single one of these costs magically transforms into a powerful tax-reducing tool. It's almost like you're getting a permanent government-approved business discount on your personal living expenses. Moving right along to Section 4, the two calculation models. Now we're getting into the mathematical divergence of our analysis. Having identified all those eligible expenses, we actually have to calculate the deduction. And the tax code offers two distinct pathways here. See this number, $1,500? That represents the absolute maximum limit of the first pathway, which is known as the simplified method. It rigidly caps your deduction at just $5 per square foot up to a strict maximum of 300 square feet. Now, it requires very minimal documentation, which makes it incredibly tempting for busy business owners who just want to save some time. But as an analytical thinker, you should immediately recognize that a fixed cap is an implicit limitation on your financial leverage. Let's move to the other side of the coin and see how the alternative builds. This is the actual expense method. And this one requires proportional mechanics. Step 1, you determine exactly what percentage of your home is used for business. You do this by dividing your office square footage by the total square footage of the entire home. Step 2, you apply that resulting percentage to the total sum of all those qualifying home expenses we listed just a minute ago. This method puts you in the driver's seat. It scales with your actual real-world costs rather than forcing you into an arbitrary, predefined cap. Which perfectly sets up Section 5, Strategic Method Comparison. This right here is the core analytical climax of our explainer today. We really need to expose a very common implicit assumption that traps a lot of people. The assumption that the easiest tax method is automatically the most beneficial one. This side-by-side comparison brilliantly illustrates the mathematical reality. Just look at the data. In our hypothetical scenario, taking the absolute maximum simplified deduction yields a flat $1,500. But if your home office makes up 10% of your home and your total household expenses are $30,000, well, the actual expense method yields a $3,000 deduction. You are literally doubling your financial benefit. The assumption that easier is better leaves thousands of dollars sitting on the table simply because someone wanted to avoid a little extra paperwork. And that brings us to an absolutely crucial expert-level actionable insight from the report. The non-obvious reality is that smart strategy demands running both of these mathematical models every single year. Expenses fluctuate, utilities go up, maybe you move and your home size changes. Settling for the default simplified path essentially guarantees that you are prioritizing convenience over your own financial benefit. The true analytical approach? Track everything, calculate both models side by side, and strategically choose the one that results in the higher write-off for that specific year. Finally, Section 6, Compliance and Audit Risks. Let's funnel down into the final, high-stakes reality of executing this deduction. We've established exactly how to maximize the yield, right? But maximizing yield inherently attracts intense scrutiny from tax authorities. Let's analyze the direct cause and effect mapping here. Tax returns filed by self-employed individuals and small businesses are inherently more complex, and statistically, they are audited much more frequently. Claiming complex, high-yield home office deductions acts like a flare gun. It signals a higher risk profile to tax auditors. If you claim an unusually large percentage of your home or massive disproportionate expenses, the tax authorities' algorithmic systems will absolutely flag it. The cause is the high deduction. The effect is a significantly higher burden of proof placed directly, squarely on your shoulders. Therefore, the absolute anchor of this entire tax strategy is meticulous record keeping. This is your risk mitigation. It's your shield. Without clear records, and I mean organized purchase invoices, utility bills, and rigorous usage logs proving that exclusive use requirement, the deduction is nothing more than a flimsy number on a page. An auditor can and will easily deny it, potentially hitting you with hefty penalties and back taxes. Proper, exhaustive documentation is literally the only valid ticket you have to legitimately retaining these tax savings in the event of an official inquiry. So, as we wrap up this analysis, I want to leave you with a provocative dual question to really challenge your own financial practices. First, Is the sheer convenience of taking the simplified method silently costing you thousands of dollars every single year? And second, if you do choose the strategic, high-yield route, is your record keeping genuinely bulletproof enough to confidently claim the actual value of your deduction? I highly recommend taking a hard analytical look at your strategy today, because in the precise world of tax mechanisms, proof and precision are exactly what separate risky liabilities from powerful assets. Thanks for joining me on this explainer, and I can't wait to dissect our next topic with you soon.